Dividends are payments made to shareholders from a corporation's profits. Many businesses pay out dividends to their shareholders on a quarterly basis. But how much money do you need to invest in order to live off dividends? In this video, we'll take a look at what is the lowest amount you need to live off dividends and how you can achieve that too. As you build your investment portfolio, you'll most likely reinvest your dividends to accelerate your wealth growth. But in the long run, could you use them to fund your retirement lifestyle? If so, how much money do you need to put aside to live off dividends? Here's everything you need to know about this income strategy, including how much money you'll need to pull it off, whether it's a realistic approach, and how to evaluate its merits. Living off the passive income from your investments and becoming financially independent is an appealing concept, especially if you can achieve it sooner than you expected. Fortunately, there are numerous ways to build an investment portfolio that will last indefinitely. One popular strategy is to invest in assets that pay enough dividends to cover your annual expenses. To calculate the amount of money you'd need to invest to live off dividends like this, you'll need to define two variables: your annual spending plan and the dividend yield of your intended portfolio. Once you have them, divide the former by the latter to determine the value of your portfolio. Assume you intend to spend $40,000 per year to support yourself and your family in the future. If you believe you can achieve a 3% dividend yield on your portfolio, divide $40,000 by 3% to arrive at a minimum portfolio value of $1,333,333. The best way to begin developing a future spending plan is to assess your current expenses and make necessary adjustments. We recommend inserting your debit or credit card into a digital budgeting tool to automatically track all of your expenses in one place. You could write everything down the old-fashioned way with a pen and paper, but why would you? It's all too easy to overlook cash transactions, make mistakes, or abandon the practice entirely. Once you've determined how much you intend to spend each year, you'll need to determine what kind of dividend yield you can reasonably expect. While your mileage may vary, you can generally expect a dividend yield of 1 to 6%. The total dividend yield of your investment portfolio will be determined by its composition. While it is impossible to predict what dividends an asset will pay out in the future, you can get a good idea by looking at its historical yields. You should be able to find them prominently displayed on the assets page of your brokerage or through independent online databases. It's tempting to build a dividend-paying portfolio by selecting the assets with the highest yields, but this is a risky strategy. When determining the value of a stock, there is much more to consider than its dividend. In fact, the highest yielding investments can be the riskiest. Divide a stock's annual dividend by the price of one share to calculate its dividend yield. For example, if a stock pays a $5 dividend per year and costs $100, the dividend yield is $5. That is, yield and stock price have an inverse relationship. If one falls, the other rises. Someone who chooses stocks for their rising yields may inadvertently acquire assets that are falling in value, which is a quick way to lose money. As a result, before adding an asset to your portfolio, you should always consider the sustainability of its yield. You could, for example, look at its dividend payout ratio, which is equal to its dividend divided by its net income. A company with a 10% payout ratio earns $1 million per year and distributes $100,000 to its shareholders. If it is more than 100% and has been for a few years, the company is paying out more than they make, which cannot be sustained indefinitely. A ratio that has been steadily increasing for a decade, on the other hand, could indicate that the business is maturing properly. If you plan to live off dividends from your portfolio, make sure you do this type of research before investing in anything. You want those dividends to last as long as possible. Remember to include taxes in your dividend calculations. Dividends received from equities in a traditional 401k, IRA, or taxable brokerage account are taxable income. They will, however, be taxed at different rates. You will not pay taxes on dividends reinvested in a traditional retirement account. However, once you begin taking them as distributions, they will be taxable at ordinary income rates. You can avoid the problem entirely if your dividends come from after-tax accounts such as Roth 401ks or IRAs. You will not be taxed on dividends reinvested or received as distributions. Make sure you understand the significance of these two types of taxation, as they can significantly skew your numbers. For example, the tax on $30,000 in qualified dividends at 15% is $25,500. The equivalent amount in ordinary dividends subject to 24% taxation is $22,800. That's a savings of $2,700 per year and $225 per month. It's always a good idea to seek personalized tax advice before embarking on any investment strategy. Consider consulting with a tax expert, such as a certified public accountant or enrolled agent, or reading what the IRS has to say about dividends. The amount you need to invest to live off dividends is determined by your annual expenses and your portfolio's dividend yield. Assume Jack is a single person who spends $48,000 per year to support himself in a high cost of living area of California. He has a high risk tolerance and is comfortable putting together a retirement portfolio that is heavily weighted towards equities rather than bonds and contains a large number of REITs with high dividend yields. He anticipates a 6% dividend yield on his retirement portfolio. Divide $48,000 by a 6% yield, and he'll need to invest around $800,000 to live off dividends. Of course, these figures are estimates. You never know how much money you'll spend or what dividend yield you'll receive in the future. Both amounts can and will fluctuate, so include a buffer based on your risk tolerance. Another example is John and Jane, a married couple from Texas. They estimate that after their children leave, it will cost them around $40,000 to support themselves. They are risk-averse and prefer to focus on wealth preservation over anything else. As a result, they construct a portfolio with a dividend yield of around 2%. Divide $40,000 in annual spending by a dividend yield of 2%, and they'll need to invest $2 million to live off dividends. While you can live off your investment dividends, it may not be the best retirement strategy. In general, you're better off maximizing your portfolio's total return rather than chasing a high dividend yield for the sake of dividends. While there is something inherently satisfying about living solely on dividends, it is usually unnecessary to differentiate between living solely on dividends and a portfolio of equities in general. In reality, there is no practical difference between distributing funds from your portfolio via dividends and selling assets. Consider this: your dividend yield is only a portion of your portfolio's total return. It makes no difference whether your 10% return consists of 5% value growth and 5% dividend yield or 9% value growth and 1% dividend yield. In other words, if an asset pays you a $500 dividend and you reinvest it, it's the same as if the shares increased and your position's value increased by $500. The distinction is that a dividend is relatively predictable, whereas appreciation is not. The only difference for an investor would be a difference in tax rates when withdrawing from a taxable brokerage account. In most cases, however, this will work out in favor of selling assets rather than taking dividends. If you manually sell parts of your retirement portfolio, you can use the first-in, first-out principle, which means that the first asset you sell is the first asset you bought. If you've been investing for years, these should always be subject to long-term capital gains taxes. Meanwhile, ordinary dividends are taxed at the lower ordinary income tax rates. If you sell portions of your portfolio manually, you'll also have more control over the timing of your earnings. Shareholders have no say over when or how much dividends they will receive. And who knows, you might be living off dividends sooner than you think. Finally, if you want to be wealthy, you must first become wealthy. Talk about it, think about it, and prepare yourself for it. You'd be surprised at how much you can accomplish. And with that being said, it's time to end our video. Thank you so much for watching our video today. Please like and share this channel with your family and friends. Subscribe to the channel for more amazing videos like this. We'll see you with another interesting video.